Hello, it's Brian Rezny. And one of the big misunderstandings about investments and investment firms, let's talk a little bit about that. If you're working with a Wall Street type firm, any of the big firms you hear about all the time, you know, the ones that have been fined billions of dollars, or you're working with the bank, or you're working with an insurance company, I'm always asked, how do these firms actually pick the investments that go into their accounts? This is how it works. If you're at any one of the big banks, brokerage houses, or insurance companies, if you, let's say, are a mutual fund company, and you want to sell your mutual fund or have their brokers at that big Wall Street firm sell their mutual fund, just to get in line for them to sell your fund, you have to pay them what's called a shelf space fee. So what does that mean? So it's kind of like going to the grocery store and you see a loaf of white bread on the shelf. Well, if that company that sells that white bread wants to be on the shelf of XYZ grocery store, they have to pay them a big fee. That fee might be $250,000 to $500,000 a year just to be able to have their brokers sell that mutual fund. So that's one big conflict. And the fund doesn't have to be good, because the brokerage firms, banks, and insurance companies don't care about quality. They care about how much money they get from that particular mutual fund company. So they pay them a shelf space fee. Now they're allowed to talk to the brokers of that big brokerage firm to basically try to get them to peddle the fund. There's also commissions involved. There's also what's called revenue sharing. The more of that fund they sell, they get an extra kickback. And then there's 12B1 fees. So the bottom line is this. If you look at your brokerage account, the only reason those big name mutual funds are on there is because those big name mutual funds paid a big upfront yearly fee to that brokerage firm so that it allows them access to their brokers. Not that the fund's good, it's only because they had the money to upfront load the brokerage firm in order to allow them access to their brokers. Is that the kind of relationship you have? If you've been sold an annuity or variable annuities or non-traded REITs, real estate investment trusts, or mutual funds, or all kinds of investments through a brokerage firm, bank, or insurance company, all those firms usually pay an upfront big shelf space fee just to get access. It's not that the investments are good, it's just that they can line the brokerage firm's pocket more, and then their brokers or so-called advisors are there to then peddle those investments to you, the unsuspecting investor. And yes, that happens in fee-based accounts at all those firms too. The only kind of firm you should ever entrust your money to is a fee-only fiduciary, like Rezny Wealth Management. If you're not a client of our firm, give us a call for a consultation. If you're tired of the conflicts of interest, the bad advice, the financial abuse of Wall Street firms, banks, and insurance companies, it's time you experience the difference we provide. Real advice, real money management, 100% of the time. Give us a call today. We do manage larger portfolios, $500,000 and up. Have yourself a safe and prosperous day.